Brought to you by runtogold.com, the premier source for monetary science applied to geopolitical, international, and economic, financial news and events. Welcome back to the runtogold.com podcast. This episode will be on backwardation. I was on a radio show filling in for Jim Willie, so here we go.
Jim Willie's Perspective is a production of Radio CICN and is produced for informational and educational purposes only. Please remember that all content is solely and completely the viewpoint of Jim Willie, does not necessarily reflect the opinions of the staff, partners, affiliates, or guests of Radio CICN or ContraInvestorsCafe.com.
Hello, everyone, and welcome back to Jim Willie and Friends. This week, we've got Trace Mayer back with us again. Hi, Trace.
Hi, Michelle. How you doing?
I am doing really well. I'm out there in sunny California, and I'm freezing here in Chicago. I'll try not to hold that against you. You know, Trace, I was really excited when you were coming back on today because I've been reading some of the articles on your website, runtogold.com, and I was really interested in a couple of articles where you mentioned backwardation in the metals, gold and silver. And I have to admit, at first, I was like, he made up that word because I didn't really totally understand everything. But you write it in a way that really helps to clear it up. And I was thinking it was really important that we do that, both on a couple of levels. One, for folks like me who are really neophytes in this area. And also, I think there's a lot of economists who don't get this right either.
Yes, I agree. Well, being the doctor of law, I suppose I can make up words and it's okay. But yeah, these are actually real words and real terms in the futures market. The two terms that are related, one is called contango and the other is backwardation. So I suppose that's what we're going to be talking about today.
Absolutely. I'd love for you to clear it up.
Okay. Well, when you're dealing with commodities, you've got these different instruments that are also related. One is called a futures contract, and the other is called a forward contract. And these different contracts, they're related because you've got the commodity that's deliverable today, and that's the spot price. And then you'll have a futures or a forward contract that allows you to get delivery of the commodity in the future. And so what will happen is you'll have the commodity, and the spot price might be, say, $100. And you can have the right to have that commodity delivered 1 month in the future or 2 months in the future or 3 months or 6 months, whatever the term of the contract is, and then there will be a price for that commodity in the future. Now, if the price today is $100 and the price a month from today is $105 or is greater than the price today, then the commodity would be in what's called contango. And if the price today is $100 and the price in the future is $95, then it would be in backwardation. And so with commodities like wheat or corn or cows or pork bellies or oil or gold and silver, depending on the market and what the market sees happening with the future, that will determine how the prices are determined and whether the commodity is in contango or whether it's in backwardation. And so it's an interesting happening when you have a commodity like gold or silver go into backwardation, because that's not normally where that type of commodity trades. Usually it trades in contango, whereas a commodity like oil would usually trade in backwardation and rarely trade in contango. So different commodities behave different ways depending on how the market perceives them.
Okay. But we're finding, according to what you wrote, we're finding lately that with gold and silver, it's the norm right now.
Yes. Not with gold. See, gold has gone into backwardation only a few times over the last 30 years. And the last time gold went into the backwardation was in December, and there was really no apparent reason for it. But what's really, really weird is that silver has been in backwardation. Particular contracts with silver have been in backwardation since the 21st of January for consecutive days the whole time. So it's up to almost 24 consecutive days of backwardation for the 1, 2, and 3-month contracts total. And then the 6-month and 12-month contracts, they were in backwardation for about 2 weeks and then went out of backwardation. But the 6-month contract just went into backwardation today. So it is very interesting to see silver slipping into backwardation.
And why do you suppose that is?
Well, see, there are two competing paradigms in finance or in economics. One paradigm is that gold and silver are just commodities. The other paradigm is that they are monetary commodities. And so you really don't want to get caught with your paradigms down, because if you think that silver is just a commodity like oil or whatnot, then I suppose it could trade as such. But if you think that silver is a monetary commodity, then when it trades in backwardation, it throws up all types of red flags. Because here's an example. Let's say that silver is trading for $100 per unit today, and silver 6 months from now is trading for $95 per unit. Which, if you have this paradigm that it's just a regular commodity, then yeah, that could be normal to think of. But if it's a monetary commodity, then silver pays no interest. Remember? And so if you buy the silver today, you have to exchange your dollars or your euros or your British pounds today, which means that you don't earn interest for 6 months. And you have to pay storage fees on the silver for 6 months. So this is why, if you view silver as a monetary commodity with a 0% yield, it makes no sense for it to trade for less dollars or less pounds in the future than today, because it should trade for more dollars or pounds. And the more dollars or pounds that it should trade for should be a function of the interest rate that you would earn on the currency and the cost to store the silver. So if you have $100 today and the interest rate is 12%, that means you'd need to earn 6% interest over the 6 months. Plus, let's say it costs $3 to store the silver. Therefore, the price of silver 6 months from today should be $100 plus 6 plus 3, or $109. Mm-hmm. But it would make no sense for it to be $95, because then you're missing out on the $6 of interest. You have to pay the $3 of storage fees. But why is the currency, the monetary commodity of silver, cheaper in the future? And so it really kind of starts sucking in the dollars and pounds into the silver for present delivery. People say, hey, just give me the silver today and then just sit on it.
Well, that actually makes a lot of sense.
So does that help clarify a little bit of that? We've got a bunch of finance professors or economists that view silver as just a regular commodity. They don't view it as money. They don't view it as a currency.
Do you think that's because silver gets used in so many other things?
Well, yeah, I think that the market might be a little bit confused on how it views silver, because there are so many industrial applications with silver, and because the worldwide economy is slowing down, so obviously we won't need to use as much silver to make cell phones or light bulbs or whatever it is. So maybe the market's a little bit confused about silver's role. Maybe, I mean, there could be any number of reasons why it could be slowing down, but I think the important one to focus on is this monetary characteristic, because silver is a semi-precious metal. It's really a quasi-currency. It doesn't have the huge above-ground stockpiles like gold does, but it's still, at all times and in all circumstances, silver is still money.
Okay.
And so that's a fundamental basic economic law that I think a lot of finance professors or economists might try to avoid. They might say, "Oh, no, it's not a currency at all times in all circumstances." But the truth of the matter is that it is, just like gold. So,
well, and traditionally it's traded at a shorter ratio than what it's trading at now, so the potential for it to grow is bigger right now, isn't it?
A shorter ratio to what? To gold?
To gold, yeah.
Oh, yeah. I wrote in my article, I did hit on the gold to silver ratio, and actually in some other articles I hit on the silver to oil ratio also. But yeah, let's see, when this latest bull started romping around a little bit, it was about 80 ounces of silver for an ounce of gold, which for a couple of years there it was about 55 ounces of silver for 1 ounce of gold. But then in October, November, when everything kind of went haywire, everybody sold their silver, but they didn't necessarily sell their gold, and probably because they were confused on its monetary characteristics. And so that ratio went up, but now that ratio has been coming back down, so it's down to about 70 or so right now. And so I think that ratio will probably continue to decrease, and it'll move back towards its mean revision of probably 50, 55, at least what we've seen over the last couple of years. But, it could have a little speculative froth and move up to like 40 or even lower.
Okay. Another thing that I wanted to talk to you about, you were talking about the curiosity of the collectors in India and how, they're zapping up a lot of the silver in the market right now. Do you think, there's been a lot of talk about silver shortages and everything. Do you think that that's a real possibility?
Well, it definitely is for the people in India, because in India they consume about 3,000 physical tons a year. And the Reserve Bank of India, for some reason, they decided to renew the license to import physical gold, but they haven't renewed the license to import physical silver. So they're trying to restrict the supply of silver to people in India, which takes thousands of tons off the physical demand market. So, yeah, for people in India, we're seeing shortages. And of course, when you look at shortages, well, what's the definition of one? And as premiums and delivery times increase, well, that's evidence of a shortage. And I was just at a conference in Phoenix speaking, and I wanted to buy a couple of the Australian Philharmonic silver coins because they're just beautiful. And I had to pay $20 for 3 of them. That was the price. And all the coin dealers that were there sold out all their inventory. So we had a shortage of silver coins at the conference because they sold everything out. So they could have raised price or they could raise delivery times. But yeah, we're starting to see quite a bit of these evidences of shortages in the market because the price over spot is increasing and the delivery times are increasing. When people say shortage, it's like, oh, well, I don't have any. Well, that you don't necessarily not have to have any supply for there to be a shortage. It's seeing those prices rise and the delivery times rise that start to indicate shortages. Eventually the shortage might get so bad that you can't, you might have to pay $1,000 over spot to get a coin and wait 10 months or whatever. So the shortages aren't super bad yet, but yeah, they could get pretty bad. And I think one of the reasons this is important, going back to the backwardation, is with a futures contract, you have mark to market on a daily basis, and then the margin limit, because when you trade a futures contract, most of them are traded on margin, and so that those margin requirements are checked daily, and so whereas with a forwards contract, you don't have that daily mark-to-market margin. And so the forward contract has a lot more susceptibility to credit risk, to the potential that the other side of the contract will not deliver their silver, which would be a silver shortage. And right. So what we're seeing is, like on the COMEX, for example, those silver futures futures contracts are not in backwardation, but the LBMA forward rates are in backwardation. And the LBMA trades a lot more silver than the COMEX. So I think that they're I like looking at their prices just because it's a deeper, more liquid market. And it's showing that backwardation also, I think a big component of it is the potential failure to deliver when they've contracted to deliver silver and not coming up with it. I think that's a big component of it, this fear of failure to deliver of silver. And that might be another reason why silver's been moving into backwardation on the LBMA. And the LBMA, I mean, that's the London spot market. That's where when you trade the physical bullion, that's where it happens. So people are obviously buying the physical silver, sticking it on a truck, and taking it over to Zurich or something probably. But they're not leaving it in the hands of somebody else, and they're not accepting somebody else's promise to deliver silver. They're saying, give it to me right here, right now. And I don't care that I'm paying more today than I would in 6 months. I don't want your promise, because I think there will be a shortage because you won't be able to fulfill your promise. So that's what I think is happening on the LBMA.
That really helps clear a lot of that up. You talked about being at Cambridge House's Silver Conference, the Silver Summit.
Yep.
And I was wondering what the overall view was there regarding, the backwardation and on these topics.
I was completely surprised. Nobody even brought it up. We're there with all the silver experts in the world, and we even had a dinner with 4 of the big silver experts, and not a single one brought up backwardation.
Really?
Which I thought was kind of interesting. And then we had a question and answer session, and I'm sitting there just waving my hands, jumping up and down, because I wanted to ask about backwardation, but we didn't have time to address my question because everyone else there wanted to ask questions too. But yeah, nobody even addressed the backwardation issue, which I thought was kind of interesting. I don't know if it's because it's such an arcane and esoteric topic, or if they just didn't know about it, or I don't know. But anyways, we didn't really talk about it, which was kind of interesting.
So what were some of the major topics? I mean, what is the overall view for the future of silver and the metals at the conference?
Well, of course, all the silver bugs, I think silver is going to go to the moon. So, and they're probably right. So it's it was very much very bullish for silver and the silver prices. They mentioned this gold to silver ratio that's a little bit out of whack. Ted Butler was talking about just the silver market in general and how much of the silver we've consumed. Because that's the interesting thing about silver, is because it is a quasi-monetary commodity. It's also the industrial commodity. So we have tons and tons of silver that are in landfills and other things throughout the world. And for a century, we were storing. We stored a lot of silver, and we had several billion ounces of above-ground stockpiles, but the U.S. government has disported themselves of all this silver. And, when there's a lot of supply and demand keeps growing, but there's the supply there, then the price doesn't necessarily go up. And now that we're in structural deficits for silver, we consume a lot more silver than we produce mine-wise. And because we've eaten through those huge stockpiles, like 10 billion ounces, I think is what Jason Hommel mentioned. Now, silver is going to get a little bit more tight, and if we continue using it in these industrial applications for refrigerators or cell phones or whatever it is, and we have people who think of it as money and want to just store it and sit on it, then that price is going to go up quite a bit because so many people want it and want the actual physical metal. Because you can't build a cell phone without physical silver. So everyone was pretty bullish on the prospects for silver, which they usually are, and so it's pretty interesting seeing a lot of their viewpoints. I think one thing that should be kept in mind with silver is that usually about 90% of its gains happen in about 10% of the time, and it usually happens extremely quickly. If you go back and look at the numbers and try to figure out standard deviations and how fast it rises and things, and so silver is a very volatile metal. It'll just sit there not doing anything for 9 months, and then it'll go up like 90% in 1 month. Except it usually happens over a period of years. So with silver, it's much more volatile, but there's a lot more upside potential to it than gold. And I think a lot of that has to do with just how gold has such large above-ground stockpiles. It's much slower to move because it takes a lot more capital to move that market. But silver's still got a lot of upside potential and not really a whole lot of downside potential because, say, right now it's $14 an ounce. Well, it can never become worthless, unlike a share of Bear Stearns or something. So you've got an automatic put on silver because it can't become worthless, and so that limits your downside. And it's only $14 an ounce, so I mean you can buy 1,000 ounces or whatever, and it's $14,000, and the lowest it might go is maybe $4 an ounce, or who knows. But then there's a huge upside potential. In 1980, we saw it go to about $500 an ounce. And actually, for my new book, I'm going to be releasing a book probably within the next month called The Great Credit Contraction. In there, I'm going to have charts on house prices in terms of silver, and so we're seeing house prices continue their trend when priced in silver, and a median price on a U.S. house would be maybe 1,000 ounces of silver, down from its record of about 43,000 ounces back in 2003. So,
wow.
So, I mean, you can use silver to perform mental calculations of value, just like you can use gold to do that. It's just a little bit more unreliable because it's a lot more volatile than gold for that purpose. But it can still function like that because going back to these competing paradigms, it's either a commodity or it's a monetary commodity. And I think it's a monetary commodity. I think people buy silver because of some of its monetary properties, like being a store of value, because it has that inherent put option on it. So,
well, and you wouldn't consider buying something with a bushel of wheat these days. I mean, there was times in the past when that might have been possible, but certainly the potential for being able to purchase something with silver is there.
Oh yeah. Well, I've got cans. I got a couple of cans of wheat because I eat wheat and I like it. So I got a couple extra cans to store my value. But you have a 6-pound can of wheat, and I think I bought that can for $2.
Mm-hmm.
Well, I mean, so I get a box of those cans of 6, and that's about $12. Or I can have a little 1-ounce coin. Which one's going to be a lot easier to store and move? A 30-pound box of wheat or a 1-ounce coin?
Right.
And then the same thing goes. Well, do I want 80 of those coins, or do I want 1 ounce of a gold coin? And so silver, because it is much more divisible, at least for the ordinary daily transactions, if you were to actually use the physical coins instead of some digital medium like gold money, for example, it does function for that because it doesn't have that huge inherent value like gold does. And I think some of that has to do with the fact that the governments have disrobed themselves of all their silver, which they haven't done with gold, which I think is really funny because, all these finance professionals and all these economists, they're like, oh, gold is just a barbarous relic and gold has no intrinsic value, blah, 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 and other just incessant babbling. And, if it does, if gold really is what you say it is, then why don't the governments just sell all of it? Sell all your gold.
Why are they holding on to it?
Yeah, why do you keep holding on to it if it's not money? oh, we don't want to disrupt the market. I don't buy it.
Yeah, I don't think I do either.
And so what would be really interesting to see is if some of the central banks decide that they want to start holding silver. Wouldn't that be fun?
You think there's shortages now?
Yeah, you think there's shortages now. Have these central banks come in and buy some silver. I think let's say there's been 25 billion ounces of silver mined in the history of the world, and let's say 15 billion of it's in the landfills. I mean, no one really knows because it's hard to track all these things. But let's assume, just for the sake of argument, that there are 10 billion ounces of silver in above ground that could possibly be hoarded and put in a central bank vault. Well, 10 times 14, we're talking a minuscule amount of metal compared to the current amount of currency illusions that are out there, like Federal Reserve notes or British pounds. So there's probably about $4 to $5 trillion of gold, at least at current prices. And so silver, 10 billion times 14, so 140 billion. 140 billion compared to 4 trillion. I mean, it's just a tiny market to get the actual physical metal. So I think there's, if there are any big players like the Saudis or anyone else,
don't be giving them any ideas.
Oh, why not? I own my silver. I'd be glad to sell it to them for when we get to about a 16 ounces of silver for 1 ounce of gold. Sure, I'll sell them some of my silver.
All right. In that case, sure, absolutely. I've got a little also too.
Yeah, they can. I bought it while it was cheap, and if they want to buy it and make it get expensive when priced in gold, yeah, I'll sell them a little bit. but yeah, and see, that's the thing. A lot of people are like, oh, don't buy gold, it's un-American, or whatever they want to whine about. But the truth of the matter is that gold and silver, they don't care who owns them, and they don't really care about a flag or they don't care about any of this. They're the market's money. Whereas in contrast to Lord Keynes, he called it the theory is called chartalism, and chartalism is the theory that the law gives money its value, versus the Austrian viewpoint that the market is what determines money's value. And, these governments, they just print up tickets and think they're supposed to have value. Well, gold and silver, they have value regardless of whether some criminal gang that's costumed in government regalia says it has value or not. And so there's nothing that they can really do about it. It's going to be valuable in itself. Right. And so the governments, they definitely have a problem when they have gold and silver allied together, making assaults on their little paper tickets.
Paper tickets, I love that. One of the things I like about the trade, say what you think and you mean what you say.
Well, yeah. I mean, what are they going to say? They're not paper tickets? I mean, that's all they are.
It's definitely an illusion. Well, Trace, it looks like we're, probably about time we should wrap down for today. And I wanted to give you an opportunity to talk a little bit about your website and about your book, and to let folks know a little bit more about what you've got to offer.
Yeah, well, my website is called runtogold.com. Real easy. You just run to gold for the safety. And there I talk about these monetary issues, geopolitics, things of that nature. And my book that'll be coming out is pretty much an autopsy on this worldwide financial system that's being kept alive on the respirator. And it'll be very interesting. I think for a lot of people, it has how this came about, why what's happening is happening, and then what people can do to protect themselves and their assets and their families. And so it'll be a really helpful resource, I think, for people. And it's going to be pretty high quality. I have an editor working on it. She's a professor at a law school, so along with a lot of the legal citations in the book. I have over 110 citations and footnotes in it. So it's a good foundational document for people to understand what's happening, why, and where they can go to get more information on it. And so that'll be coming out in hopefully a month or so. I'm working with the designer to make it real pretty for everyone when they read it. So just stay close to my website, runtogold.com, with the free email list, and when I release it, you'll know about it.
All right, very good. And we'll definitely look forward to talking with you again in about a month or so. We're really glad that you've agreed to be part of this rotation here in Jim Willie and Friends. Definitely like what you have to say and how you say it.
Okay, well, thank you, Michelle.
All right, well, we'll look forward to talking with you again in about a month.
Okay.
Well, that wraps up episode 24 of the RunToGold.com podcast on backwardation. Talk to you later. You've been listening to the RunToGold.com podcast, the premier source for applied monetary science on the web.